The Standard Deviations podcast is a weekly production that looks at money, mind, and meaning, all through a psychological lens. Each week, psychologist and New York Times bestselling author Dr. Daniel Crosby interviews a fascinating new guest, experts in everything from finance to literature to wellness.
When was the last time you splurged on something when you knew it probably conflicted with one of your financial goals, like paying down debt or saving for future fun in retirement? Well, if you do this, you're not alone. It's because of present bias, or to use the psychobabble term, hyperbolic discounting. As humans, we have a tendency to let the immediate rewards of the here and now win out over a desired future reality. To learn more, check out the Cash Dash Dash, a planning tool brought to you by the Guardian Network to see just how much your short-term spends might be impacting your longer-term financial goals. Play today by visiting www.livingconfidently.com/play. Hello and welcome to the Standard Deviations podcast. I'm your host, Dr. Daniel Crosby, and I am joined today by one of my favorite humans in the world. In her role as the Director of Innovation at TD Ameritrade Institutional, Dani Fava oversees the development of advanced investment management and technology tools designed to help independent registered investment advisors compete and thrive in a world of accelerating change. She is one of my favorite thinkers on the future of the industry, and I know that we're all going to learn a lot today. So welcome to the show, Dani.
Thank you so much for having me, Daniel. I am really grateful that you asked me to be here, and the feeling's mutual. You are one of my favorite humans.
Well, you know why. It's because we have identical birthdays and nearly identical first names, and so it's just a huge study in narcissism is what this whole thing is.
I call it kismet.
Okay, perfect. I'll take it. Okay, so you are an expert in emerging fintech. So I just want to jump straight into the good stuff. Where do you think fintech is headed, and what are the top 3 trends that you see emerging in the coming years?
Yeah, so the top 3 trends, or I'll start with my favorite 3 trends, and hopefully that's one and the same with the top emerging trends. My number one favorite right now is technology being used to enhance the human relationship. So I really believe that technology is going to make us better communicators and help us build stronger relationships with each other. And that's particularly important, obviously, in the financial advisor space. We've had for a very long time CRM software helping us organize our relationships. But what's happening now is technology is really stepping into hyper-personalization. So I believe that we're going to see technology help advisors figure out who they should be talking to, where they should be talking to that person, what that person's sentiment is, and where the advisor should meet that person in the conversation, how often the advisor should be reaching out to each individual client, and even giving recommendations on what an advisor should be talking to her clients about. I think technology, the number one trend that I see is this sort of foray into really making our relationships stronger. And I'm most excited about that one, and I hope that advisors embrace that. I know we all think we're experts at the human relationship, but I think we can all use a little bit of help, and also we can use it to scale, right? We're really good at those top 5 relationships in our lives. We're not so good at managing 100 relationships at that level. And this technology that's going to enhance the human relationship is also going to help advisors scale it. So that's number one.
Okay, so first of all, the love fest continues because as someone who's developing just such a technology, I'm obviously thrilled by this answer. But it strikes me that, behavioral alpha is widely seen as the number one value add of the advisor-client relationship. When you look at the reasons why advisors get let go by their clients, they are, again, by and large, relational. So if relationships are how we add value, if relationships are what keeps us, working with clients, why has relationship software been the last sort of the last stand. Like, why don't we have this yet? Why do we have rebalancing and CRM and every other software, but no relationship software to speak of until just recently?
My answer is going to be the advent of artificial intelligence. I really think that technology, the ability for a human to have these behaviors and for a technology to be able to predict patterns in those behaviors and then replicate patterns in those behaviors has really been the great enabler of this relationship technology that I'm talking about. And I know we're going to talk a little bit more and get a little bit deeper into AI later in this conversation, but that's really what was missing. That's kind of the key that sort of started the engine on, I think, this behavioral technology that you're talking about and this relationship enabling technology that I'm talking about is really the ability for the computer to replicate with really good results that human behavior.
Perfect. So what's your second technology that you're on the lookout for?
So the second one is voice. And by voice, I mean anything from a podcast to a flash briefing. And I really think that this is going to become very popular in the advisor space. And there's a number of different reasons. First of all, we've all become, a lot busier. We've kind of gotten used to digital assistants in our lives. And it's a really nice way to be able to consume news, just to be transient and listening to a podcast or to your daily flash briefings. So I think the world is kind of ready for more connection points outside of email, outside of paper, and more in our native, hearing in these voice channels. So when financial advisors figure out that they are going to be able to talk to their clients using a podcast with very easy or low barriers to entry, and they're going to be able to talk to their clients in their own voice at scale, that's really going to take off. I think every advisor really should have a podcast aimed at their clients. I don't think that clients consume quarterly letters and emails with the same engagement level that they consume voice. I mean, think about it. We're talking right now, right? It's much more powerful than if we were exchanging an email. We're getting to know each other better. There's inflection in our voices, and we're kind of, we're building a relationship here. Advisors can do that with all of their clients using something like a podcast on a regular basis and be able to get that out to all or most of their clients at once. So number two for me is definitely voice for financial advisors.
So what strikes me about voice is that it's simultaneously passive and intimate. So to explain, right? I've listened to an hour and a half of podcasts today. I go to the gym for about an hour, and it's about a 15-minute drive either way. So in that time, you can't read, you can't type, but you can listen to podcasts. So about every day, I listen to an hour to an hour and a half of podcasts. And so in that respect, it's passive. You can be doing other things. But in another respect, it's deeply, deeply intimate. I feel like that passive word doesn't give it enough credit because it's deeply intimate. Like you feel like you get to know the hosts. I just took my daughter to a meet and greet of her favorite podcasts because now 100 episodes in, she feels like she knows these people that put on this podcast and really wanted to get to know them. So it's simultaneously you're able to multitask and you really develop, I think, a special kind of relationship. So I think it's a unique and powerful medium for all the reasons you suggested.
Perfectly put, Daniel. And the other thing about it is that it's much easier to give a referral if you're telling somebody to go listen to a podcast, right? So I've had a lot of friends ask me because of my, position in the financial advice space. I've had a lot of friends ask me to recommend a financial advisor. And it's one thing to just, give a name and a phone number. That's sort of, like what I would call a hard referral. But I can instead give a couple of podcasts and I say to my friends, hey, why don't you listen to these 3 podcasts? They're run by or produced by financial advisors that I know and respect. And by listening to them, you will do exactly what you said, Daniel. get to know their personality before you pick up the phone and make an appointment to go visit, right? So it's also a channel that enables an easier referral point, which is just another benefit. Here you are building this channel and building a deeper relationship with your current clients, but you're also giving them a way to pass on a soft referral to their friends and family and acquaintances in a really meaningful and powerful way.
Fantastic. I think one of my favorite studies about therapy looked at the best predictors of success in therapy. And the best predictor of success in therapy, basically whether or not the client got better, was not the number of years of school the therapist went to. It wasn't their sort of philosophical orientation. It wasn't any of those things. It was just the connection between the therapist and the client, like the level of rapport. And I think you could take 2 or 3 financial advisor podcasts, listen to those podcasts, and get a great sense within 1 or 2 episodes of who you wanted to work with, the level of fit, the level of natural rapport between you and the advisor in question. So it makes you easily referable. It allows clients to vet you and sort of self-select in or out. I had never conceptualized, candidly, voice as a form of technology of the future, but I think you're absolutely changing my mind. I think it's very powerful. And that sound you hear right now is 10,000 advisors starting podcasts. So well done.
Great. I'll be happy about that.
Yeah,
more 3. For me to refer. So number 3 is actually it's been around for a while, even longer than voice. So number 3 on my list is direct indexing. And the reason why I'm calling it an emerging technology, and actually let me pause for a second for anyone who's listening who's not sure what I'm referring to. Direct index, in its simplest terms, is the act of investing in an index by buying the individual names or the individual positions inside of that index. So that's, in its simplest form, that's what it is. I think it's one of the biggest emerging technologies now because there's this kind of convergence of multiple themes fueling the growth of direct indexing. One of the biggest ones is zero transaction fees, right? As you know, TD Ameritrade a couple of months ago, along with a bunch of other custodians, have eliminated transaction fees, which I think was one of the biggest barriers to direct indexing. Another one is the enablement of fractional share trading, right? So if you were going to go buy all of the names in the Russell 3000, you better have enough money to do it. However, fractional share trading lowers that barrier to entry, so enables smaller accounts to invest in direct indexing. Another theme that's happening that's also fueling the rise of direct indexing is that advisors are increasingly looking for ways to differentiate themselves. And part of the real beauty of direct indexing and a lot of the tools that are coming to light that enable direct indexing is that the advisor can customize a portfolio for her client. So if I have somebody who I want them to invest in the S&P 500, or they want to invest in the S&P 500, but they already have exposure to a specific asset class, I can use direct indexing to build a portfolio around the asset class that they have exposure to. And another way an advisor could differentiate herself would be to add a socially, responsible investing layer onto the direct index. So imagine I said, hey, I can invest you into the Russell 3000, and kind of get you a similar return and risk level. But I can also focus on companies with women in leadership. And maybe I'm doing that for a social tilt, or maybe I'm doing that to generate alpha in addition to the regular Russell 3000 index. But these are just tremendous ways that advisors can differentiate themselves by using one of these direct indexing tools. Furthermore, there's the tax harvesting ability, right? So very different than holding a mutual fund that represents the index, where you can't harvest the individual gains and losses within that fund. Direct indexing and owning those separate names gives the advisor the ability to do that, to manage the gains and losses in a much more efficient way and a much more personalized way. So, a way that matches the client's individual unique needs.
So there's there's ESG, socially responsible benefits to this potentially. There's tax alpha to be had potentially. And there's also, what we can call behavioral tilts, right? People have excessive exposure to a given asset class or a given part of the market by dint of where they live or how they work, or maybe some shares they've inherited. So all of these things are overcome by direct indexing. I am myself a huge believer in direct indexing as a big part of the future of fintech and Wealthtech. So I ran a survey, a highly scientific Twitter survey, right? But it did get 500 or 600 respondents recently, and I asked, what do you think about direct indexing effectively, pro or con? And it was split neatly down the middle. About half of people were very excited about it. About half of people didn't see what the big deal was. Critics of direct indexing, what are some of the main criticisms of direct indexing? And do you think they make valid points or not?
So one of the biggest criticisms that I've heard, and I went out and solicited this information, right? I kind of asked some people, why don't you do this? And what's holding you back? And I think there's the feeling of, we've been down this road before. 20 years ago, when many advisors started investing in SMAs or separately managed accounts, they had this sort of feeling of overwhelmed clients. I have too many positions in my portfolio. I, have too many holdings to give my accountant at the end of the year. This is crazy. Why do you have so many trades happening? Now, in thinking about that, I said, well, 20 years ago, we didn't have the kind of user interfaces that we have now for clients, right? Clients were literally getting quarterly paper statements in the mail. And they didn't have, these beautiful user interfaces that we have now online on our apps that break down the information in a much more digestible way. So I question, are there some of those feelings that are left over from clients being overwhelmed and having to flip through these pages? Are some of those reservations now solved by the way that clients interact with their accounts in today's day and age? Maybe not all of them, but are some of them solved? So that's been one big criticism, that I've heard. It's just quote unquote easier and cleaner when you see one line item on the screen or on the paper rather. It's just, easier for the client to digest.
Certainly a fair point, but I think you make a great point in response, which is to say that the technology has changed dramatically, and I hope that listeners will watch this space. I'll be writing and speaking a lot more in the future on the behavioral benefits of direct indexing, because I think it's one of the most exciting developments to occur in our industry from a behavioral perspective in a very long time. And I think there are some powerful things can be done there. So stay tuned. So we've talked about your big three for the future. Let's flip the script a little bit. On the flip side, you've been in this industry over 15 years now. Take it back 8, 9, 10 years. What was a trend that was supposed to materialize that never quite did? What's an overhyped trend of the past, and what went wrong?
Yeah, great question. The reason why I love this question is because I'm sure that no matter which way I answer it, it's going to piss somebody off. So I'll just, go forward and understand that someone will be mad at me. And I won't even go that far back into the past. I think, my answer to this one, and cryptocurrencies and tokenized assets aside, not included in my answer for one of the more overhyped technologies at the moment is blockchain. So when blockchain first kind of hit the scene with cryptocurrencies, with Bitcoin, and people really started understanding the potential power that blockchain had just by, being this immutable, decentralized ledger. A lot of folks started writing about and predicting that blockchain would be used for just about every transaction you could think of, including trading, trade confirmation, custodial transactions, or, security execution, cash movement. And I don't think that that's come to fruition yet, and I don't actually think that it's very close in the future to happening. And the reason why I think it hasn't happened is because the way that it was approached, or the reason why some folks thought that it would work, was they were starting in the wrong place. They were starting with the solution, right? They were trying to apply that solution, being blockchain, and find a problem for it to address, instead of the way that real transformational change happens is when you start with a problem and you say, what is the best way to solve this problem? So I don't think there were a lot of people out there saying, cash movement is too unpredictable, or securities transactions are too slow or too expensive, or, I want more securities transactions to be anonymous, or, those were not problems that were being stated and that needed solving by this big transformational and very powerful technology, which it is. It is very powerful technology and can solve a lot of problems. But I think that the hype in U.S., securities and cash transactions was a little bit overblown. And I don't think that we're seeing blockchain materialize in the way that we thought it would maybe, a year and a half, 2 years ago.
So it's a very nuanced answer. So hopefully you haven't upset anyone, because I think you're right. It's a solution in search of a problem. And while blockchain is enormously powerful, this idea of a distributed ledger doesn't solve every problem, right? There are problems to which it's ill-suited, and people were looking, to apply it to everything under the sun because it was so hyped. So still the powerful solution, but just for perhaps a more niche set of problems. There shouldn't be blockchain for ice cream or, whatever. Okay, so no discussion of technology would be complete without a nod to AI, of course, a field that it is both enormously exciting and at times, again, massively overhyped. So one concern with AI that has been legitimized in recent years is that we will program many of our human biases into AI, effectively making them law. What's scarier about this still is that it allows us to sort of hide behind the computer, right? To not be introspective, to not sort of own what's going on with us, and to just say that the computer did it. So when people are thoughtful practitioners of AI, what steps need to be taken to ensure that this doesn't occur?
Yeah. So let's talk a little bit about that AI bias. So the way that, and let me start by saying, the way that AI is built, and I don't like to use the word programmed, right? Because you don't program artificial intelligence in the sense that you would program an algorithm. When you program an algorithm, it's predictable, and you tell it exactly what you want it to do, and the outcome it should give you if you wrote the algorithm correctly. AI and machine learning is very, very different. You train it, right, by giving it data and letting it figure out patterns on its own. So it's not, I don't really even like to use the word program. And the example that I give of this, to break it down into really understandable terms, is that it behaves very much like the way the human brain would figure something out, by witnessing patterns. So if I went outside right now, I would say, hey, I think it's going to rain. And I would go back in and get an umbrella, and I'm probably right. And I never read a book, or no one ever programmed me to understand why it's going to rain. I just know it based on my experiences. If I had to break it down into words, I would say that the sky is a certain color, or there's a certain smell in the air, or that, the temperature feels a certain way. I almost can't describe it, and I can't program it, but I learned it through my experiences. So that's the way that AI works. It learns using this massive amount of data, and it predicts its own patterns and is able to then replicate those patterns. So when we talk about bias, it's really interesting because it inherits the bias that's in the data. And I think a great example of that was when Amazon launched their resume screening tool that was built using artificial intelligence. What Amazon did was it fed that tool a bunch of resumes that some humans at some point decided were quote unquote good resumes, right? So the human condition, we look at a resume, many of us, and say, yes, this person is, seems strong, and they've really talked about their skills in a meaningful way, and they even exaggerated some skills perhaps, and, very, very ambitious tone. We like it. This is a good resume from a good employee. But we have to remember that that data that we're feeding the system was already wrought with human bias. And what ended up happening with Amazon's resume screener is that it was bubbling up or screening out mostly resumes from men, because traditionally most men, or traditionally men more so than women, will speak about themselves using very strong terms, sometimes exaggerate their skills, no offense, really sound ambitious. And basically what Amazon had to do with that tool was just unplug it. You can't reprogram it because it wasn't programmed in the first place. It was trained using a massive amount of data that was already wrought with human bias. So another example of, I think, where this has also happened, it hasn't come out yet, but it's my opinion that this is what probably happened, is Apple's credit card more recently, right? Apple's credit card was giving higher credit balances to men over women, even in some cases married couples who had the same credit history, same household income, opened the credit card at the same time, and the men were getting exponentially higher credit limits. And that, again, is a symptom of years of human bias built into the data. At some point in history, there was a human being making the decision on who should get a higher credit limit, and some bias was already built into the data. And so it's virtually unavoidable, unfortunately. Now, I'm going to kind of spin the question and sort of answer it in a different way. We're assuming that this bias that's built into the data is going to be always it's a bad outcome, right? The machine is making a decision that is going to be obviously biased. But there, I think, is a really great opportunity. We now know, and we will find biases much faster and be able to address them, whereas previously it's a little gray, right? You couldn't really say with beyond the shadow of a doubt that this one person was biased, or where is the bias coming from. I think that this AI being trained with this bias inherent is going to actually be very enlightening to the world, to different industries, to people who are recognizing now that there is bias in the data at a very large scale. Basically, the computer is telling us that, and we're experiencing it. And I think the first step to solving any problem is awareness. So I think right now, the bias that's being quote unquote built into the systems, where that AI is replicating the bias, is actually bringing us more awareness of the biases that we as kind of a human race already have been dealing with for a very long time.
It's incredible. This is why I love your insight so much. I've followed this bias conversation very closely, and I'm aware how with the resumes, it's systematically discriminated with respect to gender, with respect to, in one case, discriminating against people of color. And I've always thought of it as this negative thing, but you've kind of flipped it a bit and said, look, this is one of the ways that we can quickly become bias hunters. We can unearth natural human biases that maybe we're slow or reticent to accept or recognize in ourselves. And once these are brought to light, then we can teach ourselves and begin to fight them anew. I think it's a powerful way to think about this. So the training is only as good as the data are clean. And it's a powerful thing to think about. And I think you did a great job of differentiating the training involved with real AI from simple, a simple regression or a simple algorithm. They're very different things, and they have very different requirements of the data. And I think that's important to keep in mind. So AI has been around forever. I think people sometimes think that these are new conversations. They're not. In the 60s and 70s, it was largely thought that AI was going to change the world. And then there was this, what's now called an artificial intelligence winter, because the hype surrounding it was so dramatic and the execution was so flawed that people became disenchanted with it. Do you see any signs that there is so much hype now that we're at risk of another AI winter, or do you think that AI will have a real impact on our industry this time?
I really do believe that AI will have a real impact on our industry. I think advisors are really searching for ways to get human-like recommendations, right? To have some kind of artificial intelligence help them make decisions at scale that they believe, like advisors really are their specialty, like we said in the very beginning, are relationships. That's really the great differentiator, and really what creates sticky relationships with clients is relationships. And the relationships have been impossible to scale up until now. And I really think artificial intelligence is going to show up in ways that we were not previously anticipating in the advisor space, helping them scale the very thing that they're really good at, which is building the relationship. Now, another thing that you said that kind of made me think for a second is, right, there is this hype, and it's very exciting. And so a lot of fintech companies, they lead with AI, right? Everything they're doing, it's AI, it's artificial intelligence, and we can't discern whether it is or isn't. Not enough people understand what questions to ask, what to kind of really uncover if this fintech vendor or this technology solution is really using artificial intelligence and if it works. So I always like to impart some advice to financial advisors that I talk to on how to really dig through that and tell the difference between a fintech firm who is just using the word as a buzzword and one that really has created an artificially intelligent machine. And the question goes back to bias. I think the best question that an advisor can ask any fintech firm who is selling an artificially intelligent program is, how do you rid your program of biases? And it's really a trick question because you can't, right? You cannot, if you try to rid the artificial intelligence of bias, that means, you've messed with the data that you put into it. And just by virtue of messing with the data that you put into it, you've already created a different kind of bias, right? So it's a trick question when you say, how do you avoid biases in your data? The answer really should be, you really can't. You're taking this massive amount of data that's pre-existing, and there's really no way to avoid it. That's the real answer. And I think that's a good, easy to remember question that financial advisors should be able to ask anyone that's pitching them an artificially intelligent solution.
That is absolutely fantastic. And like with any promises around returns, nothing should scare you more than someone who says there is no bias, right? Like, there is no bias. You've got one of two things. You've got something that's not real AI, or you've got a liar on your hands. Neither one of them is perhaps what you're looking for. So absolutely love that question. So Dani, as we begin to wrap up here, something I love to do with all guests on the show, it's a throwback to my days as a clinical psychologist, as a shrink. It's free association, where you lay back on the chaise lounge. I just throw out a term or a phrase, and you give me the first thing that comes to your head. You ready?
I'm ready. Yeah.
Okay. So the first one is your dream kicks.
Oh, my dream kicks. Well, everybody knows I'm a Jordan girl, but my dream kicks are the Air Max 98 Chinese New Year print sneakers by Nike. I don't own them because no one should spend that much money on sneakers. But every week or so, I bring it up on my Google search, or the whole Air Max 98 animal pack. and I just look at them. I love them. They're not vegan. They have pony hair and snake skin, both in the same sneaker, and they're wild. But those are my dream kicks.
Those are dream kicks. My goodness. No, I've never seen those, but I think that's a fantastic answer. Okay. So the next one is an impactful technology that no one sees coming.
Ooh, that's a hard one. We've talked about so many technologies already. I'm going to have to go, I'm going to have to go with something that I'm interested in that I don't think a lot of people know exists yet, but it does definitely exist, and it exists in a lot of the newer Android phones already, is gesture-based technology. So this is kind of where you can wave your hand or make some kind of motion, and the sensors inside of the technology will see that motion or detect that motion in the same way that voice technologies work, like Alexa. The technology will detect your gesture, and you'll be able to control the technology in your home or in your office using gesture-based computing. So I picture, being on the phone and wanting to lower the volume of my TV or shut off the lights. It kind of reminds me of the clapper, but yeah. But I think that's an exciting technology that I don't think many people know just how advanced that's becoming.
So I had never heard of that. Two things came to mind. The clapper was the first thing that came to mind.
We're really dating ourselves with that one.
We are dating ourselves. I have always thought that was cool. And then the second thing was, could I make my phone ring from across the room by gesturing to it and get out of a meeting by pretending to have an important phone call? So here's hoping that technology gets to the place where I can surreptitiously exit a meeting. So there's a lot of talk always about active and passive investing. So we're going to say we're entering the new decade. What do you think the active passive percentage split will be in the year 2030? So roughly 10 years from now.
Oh man.
What will the active passive percentage split be?
Oh gosh, that's so hard. It's so hard to say. And investments are specific investments are definitely not my specialty, but I'm going to give this one a shot just by thinking about private equity, thinking about how many or how few, I should say, IPOs we've had, how over the last 20 years, the number of publicly traded securities has been cut in half. I think that passive, is going to win. I think, we'll see a little bit more of a fight from active, but I think in 2030, if I had to guess the split, I'm going to say close to 85% passive.
85% passive. I know there are some hedge fund managers who will write articles. If that prediction comes true, I predict a spate of worried articles. So perfect, 1585. I love it. And then the last one, easy one. What's your perfect day?
My perfect day is laying on the beach, white sand, about 82 degrees and sunny, with a really good book in my hand.
Perfect.
What does the psychologist say about me based on my answers?
I say you're very unique and you're very deep. That's what I say about someone who loves to lay on the beach and read books. It depends on the book, right? It depends on the book. Are we reading the Da Vinci Code, or are we reading The Behavioral Investor by Daniel Crosby? That's gonna.
I have read both of those books.
They're both excellent. I did. Don't tell anyone, but I did eat up the Da Vinci Code in its day. So, Dani, thank you so much for sharing your insights with us today. Absolutely incredible. You've given us some really great things to think about. Some things to think about when buying technology. Some things to think about to position ourselves for a tech-first future. If people want to learn more about you and your work, where can they find you online?
Twitter is the best place. I'm pretty active out there on Twitter. It's Dani Fava _TDA for TD Ameritrade. Love to see you on there, Dan, as where we met, birthday twins. forever friends now, and hopefully I'll meet some new people there too.
Perfect. Thank you so much again.
All opinions expressed by Dr. Daniel Crosby and podcast guests are solely their own opinions and do not reflect the opinion of or endorsement by the Guardian Life Insurance Company of America, Guardian, and its affiliates, subsidiaries, employees, and agents, including Park Avenue Securities and the Guardian Network. This podcast is for informational purposes only and should not be relied upon as a basis for legal, tax, and investment decisions. The opinions are based upon information participants consider reliable, and Dr. Crosby and Guardian are not responsible for the consequences of any decisions or actions taken because of the information provided. Guardian copyright is a registered trademark of the Guardian Life Insurance Company of America. All materials are subject to United States copyright laws. Copyright 2020 Guardian. 2020-105108, expiration 07/22.